Hey, what's going on, Cashflow hackers? It's Chris. Welcome back to the Whole Life Insurance Masterclass with Life 180. We are getting deep into this thing at this point in time. So if it's your first time here and you're just seeing this video for the first time, and maybe this is just the first video you clicked on, I really encourage you to kind of hit the pause button right now. Go back and watch. I'll put a link above the screen here. Or if you're coming through the actual course that I have this in, make sure you go back and you go back to the first video, because doing this masterclass in sequential order is going to be super important for you to be able to understand all the concepts, because at the end of the day, what we've talked about so far in this course, we've talked about a lot, but really the focus about being able to utilize whole life insurance as a foundational asset to help you accomplish your goals, starting with your core values, getting really clear on what you want the objective in your life to be, what you want your life to be about, and utilizing whole life insurance as a foundational asset to help grow with you and help you increase your level of certainty of accomplishing these goals as you go through life. That's really what it's about. We do things by stopping thinking about rate of return and think about things that we can actually have more control about. Things like control of cost of capital, opportunity cost, understanding financial efficiencies and different things of that nature. And that's what we're going to talk about today, because ain't no mistake about it. I'm not going to sit here and tell you that whole life insurance is this magical tool that's going to just make you wealthy. If you die, it's going to make your family wealthy. But really, the value of this tool is basically having a bond alternative that you can leverage to help create wealth along the way, right? So the long-term inherent nature and value of having a safe, predictable asset that's going to grow in value every single year without fail, you can't underestimate the value that that brings to the table. But really, that's not going to create wealth. That's going to help you later in life, right? And it's going to be something, if you don't do it early, it's going to be something you would wish you had done early, or at least earlier in your life. But really what it comes down to is what we're focusing on financial efficiency. Because if I could show you a way that you could accomplish more with the same dollars, that's really what financial efficiency is accomplishing more or better results with the same amount of spend, or with the same amount of cash flow, however you decide to think about that. But the bottom line is understanding how to use the whole life insurance policy, and understanding that it's not just taking your money, putting it into a policy, letting it sit there and thinking that's going to solve all your problems. How you behave, how you leverage the policy, how you lean on this policy to help you create more positive results in other areas of your life is going to be the key to your success. So with that said, what I'm going to do now is I'm going to get to the board here, and I want to kind of go through a couple different scenarios that we see, because when we think about traditional financial thinking, this is the way people think. Now, this is my horrible attempt at artistry, but what we look at here is this is kind of what I say is like, okay, say these X's are holes, right? So the idea is like people have little water in their bucket, right? But the problem is most people have these financial leaks all over their financial world. So money is just sieving out of their financial world, and it's creating this like puddle all around your life. And what's happening is this water's leaking out. But the problem is most people will turn on, a faucet, right? A faucet here. And what they do is they just try to like really pour a lot more water into the bucket. But the problem is the more you put in, there's an inefficiency. And this money, this water is flowing out of the bucket. So doesn't it make sense to patch the holes, right, before we fill the bucket? That's really what we're talking about with financial efficiency. The problem is most people don't do this. They just try to keep jamming more water into their bucket thinking that it's going to solve their problem. But the bottom line is you're just going to have more waste if you do that. There's this thing called lifestyle creep, right? There's this debt creep, that what happens is the more income you make, the more success you have, the more these problems tend to grow with you. And if you don't handle the challenges in that way, then the problems just become bigger and bigger and bigger. So that said, one of the things I want to do now is go through two different variants of probably the most common financial profiles that we have in this country. So the first one is a saver, and the second one is what I call a debtor. So a debtor is the most common one. And so what we're going to talk about with a debtor here is the fact that, what does a debtor do? I'm going to just think about this in terms of a car. A debtor says, all right, well, I have income, right? So because of the fact that I have maybe, $100,000 per year in income, I can go buy a car. And so what are they going to do? They're going to say, all right, the idea here is I want to buy a $50,000 car. So what do? They go $50K in debt. And so they go down in debt right here. They go down in debt to buy this $50,000 car. And then over the next couple of years, they make payments, they make payments, they make payments, they make payments, right? And they go through this process. And at the end of 5 years, they have their car paid off. And typically what happens is they wind up, trading that car in, buying another car, going $50K into debt again. And at the end of the day, here's the danger with this, is if something bad happens to you at year, we're talking year 1, year 2, year 3, year 4, year 5. If something happens bad to you in year 3 right here, you lose your job, something of that nature, and you've got a hefty car payment of, say $600 per month, or in this situation, probably more like $800 a month for a $50,000 car. But if you got an $800 a month car payment, this is a situation where now if something bad happens to you in year 3, you're pretty exposed. And this is where auto repossessions and things of that nature come in. And what happens is debtors go through this process and they repeat this cycle every year. All the while, what happens is out of this situation, the average person is paying about $8,000 in interest expense to the bank, right? So what's happening is that this interest that is paid in this scenario for a $5,000 car, you're going to be going through this process where every 5 years you got 8K, another 8K, 8. So over 4 car buying cycles here for 5 years, we got $32,000, not to mention the opportunity cost, meaning what would that $32,000 have grown into from a financial perspective had you just been able to invest that money. So the opportunity cost, as we've talked about in this, is a very real thing. And so when we look at that, the question is, why would people become a saver? Well, people become a saver, because it's a better scenario, right? Because in a sense, you're paying $50,000 and you have the car. But the thing is, let's say you have that $50,000, you've drained your reserves to zero to buy this car. So now what happens? You've got a car, but you've got to save up to buy the next car. Let's say you're saving $10,000 a year at $50,000. Now, why do people do that? They do it because they want to avoid this $8,000 of interest expense, right? But the challenge is, at the end of year 5, if you want another car, you have to sell your car, and then you got to drain your reserves, right? Now, I'm obviously not taking into account inflation and the fact that cars are going to be worth, or probably be more expensive, the next car you buy, but the principles here don't change, right? So as we go down this path, we buy our second car, we save up again, we buy our third car, we save up again, we buy our fourth car, and you just basically, you buy based on cash, you avoid the $8,000 in interest expense for the car for each buying cycle. So you recapture some of this interest. So it's more efficient than a debtor. It's more safe, in that sense. But the bottom line is, at the end of the time here, you could see this zero right here. You notice whether you're a debtor or a saver, at the end of the day, you end up in the same place. You end up at this zero. By the time in this scenario, just with this graph that we've gotten through 4 cars right here, you have zero money. You've worked up, and you basically, let's say you're 65, so that means at retirement, now you want to buy another car. You either got to start saving and keep saving out of retirement income, so you got to have that there, or you have to go more into debt in retirement to make this work, right? That's what you have to do. And to me, when I look at this, I'm not trying to convince you that being a debtor is just as good as being a saver, because being a saver is absolutely better than being a debtor. Debtor is the worst thing to do. Don't do it. You're just transferring this money away unnecessarily. This is what we call inefficiency when it comes to personal finances. When I talk about focusing on rate of results and not rates of return, we have to look at our full financial picture. People are so focused on going through, and I got to do this down here. People are so focused on going through their life and being like, all right, I make $100,000 a year. I want to save $10,000. I'm going to save 10%, which is $10,000 per year, savings per year. And so I'm gonna invest $10,000 per year, and I'm gonna go try to chase an 8% rate of return on average. So what does this mean? It means I'm taking this 10%, which is $10,000, and I'm risking money to earn $800, because 8% of 10,000 is $800. Now, at the end of the year, I have $10,800. The problem is with this, if we've invested $10,000 out of the $100,000, that means we have $90,000 left. This is our lifestyle money. So if we focus on this, I would ask everybody here, do you believe you have the ability to find 5% of financial inefficiency in your life? If the answer is yes, I'm going to tell you right now, that's $4,500 of this $90,000 that you have. And so $4,500 off of this $10,000, I'm not saying don't invest, I'm saying this is the equivalent of a 45% rate of return on this number, without taking any of the risks that you had to do chasing this 8% to get that $800 return, right? So this power right here, when I'm talking about focusing on rate of result, I'm talking about financial efficiency, getting your same dollars to accomplish more simply by learning how to leverage your money in the right way to accomplish your goals. And let's not focus on returns, let's focus on what am I trying to achieve? What are all the different moving parts? And your financial advisor typically is not going to be able to tell you what to do when it comes to investing, when it comes to, well, they'll tell you what to do with investing, but they won't be able to tell you what to do when it comes to making the best purchases for your cars, right? Or other inefficiencies in your life, talking about your insurances and stuff like that. Most financial managers just don't manage that. So this is what we call a wealth creator. And to me, this is a hybrid model. And when we talk about the power of whole life insurance, and when we go back and we talk about utilizing these policies the way that I shared before, and I want to go back here and I want to show you this one example, right? Just really, really quickly as we get into this. And I want to show you as a 35-year-old, okay? Let's talk about this real quick. So let's say at a 35-year-old that you were going through here and you wanted to save up and buy a $50,000 car. So by saving this $12,000 per year for the first 5 years, you'd have $57,000. You have the death benefit there, so it guarantees, the loan, so to speak. You could borrow against this, you could leverage this. Now, when you borrow against it, rather than paying a bank that $8,000 that I was talking about, you would take this money, you would pay it back to the policy, back to the insurance company. But because of the fact that you never took that money out of the policy, this money is going to keep growing. You're never interrupting the growth of this money, right? It's a secondary transaction. So it basically takes the interest expense that you would normally have, it lets you recapture that lost interest expense cost, and it creates more financial efficiency in your world, and it helps reduce the opportunity cost in your life, which when you do this out over a long period of time, it adds up to amazing, amazing results. And so when we look at this, that is what I'm talking about. I call this the wealth creator. So the wealth creator, what is the wealth creator? The wealth creator is somebody who kind of is a hybrid between a saver, which is somebody who delays gratification and saves and pays down and spends cash, right? Thus incurring the opportunity cost when they have to spend the money on the car and they give up control of that money, because when you spend this $50K on buying that car, yeah, you avoid this $8,000 expense, but you also lose the ability for this $50K to keep earning interest for you, right? So make no mistake about it, nothing in life is free. There's always opportunity cost to be considered, right? That's something that's super important to take into consideration. So what it's doing is saying, hey, capitalize your account in a whole life policy. Rather than being a debtor, implement good saver behaviors and it will save you, right? Like that's a thing. And then instead of going into debt, you leverage and you have safe debt with your policy, and you borrow against your policy, you leverage it. And when you pay the policy back, when you pay the insurance company back, what happens is your policy keeps growing all the while. So when you pay that loan back, you have more money than where you started, right? Like this is a big deal. You pay this policy back, loan back, your car's paid off, and you notice the difference between here and here is a significant amount. Now, obviously this is not to scale, this is just to teach a principle, but you repeat this over and over again, here and then here, right? So I could show you, and I've done math on this and I've got clients, and I could show you that the math and the studies that on a guaranteed basis, guaranteed, by the way, without changing any of your cash flow, because the one thing I want to say here is you don't just go buy a car in this example that's bigger and badder and faster and sexier and all these things. You don't go buy one that is all those things more than you would do otherwise, right? Like you're not using this to elevate your life and buy bigger things, because there's always a cost to doing this stuff. What I am trying to say is, if you have to buy a car and you know you're gonna buy a car anyway, buy it the most efficient way possible. That's what I'm trying to say, right? So if I could show you that if you knew that that car for you was a $50,000 car and that's what you were gonna buy, right? And you knew that you had 7 buying cycles, let's say a 35-year period from 20 to 65, right? 35 years, 25 to, is it 25 to 65? No, 30 to 65, I think is what I'm talking about. So 30 to 65, sorry, got lost there for a second. 30 to 65, you have 7 car buying cycles. Just with that alone, by doing nothing else, not changing your cash flow, just continuing to save the way you buy your cars, because of the fact that we're recapturing that lost opportunity cost and the expense that you're paying to the banks, and you're never interrupting the growth of your policy right here. That is the key. So just doing that, you're gonna have an extra $250,000 plus. Maybe just a little bit depending on what dividend rates do, but at the 5.2% assumption, you're gonna be plus $250,000 in extra money just the way you buy your cars over that period. And I don't know about you, but when I'm looking at the results for people that are hitting retirement right now, the average person in middle class United States barely has $250,000 saved for retirement. I'm talking about simply taking what you're already doing, buying these $50,000 cars. If you have a $30,000 car, scale the numbers down. If you got an $80,000 car, scale the numbers up. It doesn't matter. What we're talking about is efficiency. If we're not talking about cars, we could be talking about a lot of major capital purchases. If we're talking about, if you're a dentist, if you're a chiropractor, you need to buy major capital equipment for your businesses. How are you financing that? Are you paying cash? Are you being a saver and you're paying cash to be able to do that? Or are you being a debtor and going into debt for it? It doesn't really matter what we're talking about. It could be a car, it could be a dentist, it could be a doctor, it could be anything. If you have any major capital purchases, the principles of what I'm talking about do not change. They are non-negotiable, and they're absolute. Like this is not something that changes. It's all about the principles of how money works. And that's why I always tell people the most important thing in your life to do is to control opportunity cost. And the only way to control opportunity cost in the most effective, efficient way possible is by utilizing whole life insurance as a foundational asset in your life. And when you see this, and when you see what we've talked about so far, about the importance of being clear with your purpose, the importance of understanding what your mission statement is in this life, what you want to accomplish in life, what you want your life to be all about, what you want your legacy to be about, when we focus on the hierarchy of financial needs that we talk about and building up, and how whole life insurance fills all those needs. And now when we're talking about financial efficiency and how it can help you just be a better consumer, because make no mistake about it, you buy a car, I buy a car. Listen, I love my Jeep. I love it. I love it. I love it. It's the best purchase I've ever made in my life. No joke. Like, it's a depreciating asset, but I got more joy out of having that thing, and I would do it again in a heartbeat. That said, I'm a consumer. I have that. It's a lifestyle decision. And therefore, if I'm going to make that decision anyway, which I'm going to 100% of the time, I want to do it in the most efficient way possible. So my question to you is, where are the areas in your life where you have inefficiencies? Is it where you have deductibles on insurance? Is it the way you have your things financed? Do you have high interest credit card debt and money sit in the bank? Do you have other areas in your life that are just inefficient that you need to address? I would encourage you to dig deeper and look at it. If you have any questions about anything at all, please, this is the end of the masterclass. We've gone through everything that you need to know to understand whole life insurance in its basic forms, to be able to dive deeper, to be able to ask more critical questions, to be able to understand the questions that you need to ask as to how this might pertain to your personal financial situation. So I would really, really encourage you, go down in the link in the description below, set up a clarity call with somebody on my team, one of my certified coaches, and they will help answer all your questions for you. The goal for this is to not sell you something. It's to, I believe, whether you do it with us or whether you do it with somebody else, you need to do this. And so the goal is to at least get your questions answered so you have clarity about whether it's right or not for you. Sometimes it doesn't make sense to get a whole life insurance policy right away. Maybe you're in a situation where your debt is through the roof and it doesn't make sense for you to do it. Maybe you got to go get a convertible term policy. I'm not sure. But either way, I know that looking into this stuff and doing something about it today is going to be one of the most important things you can do. I've already showed you the cost of waiting, so don't sit on your hands with this. Do something. Your family deserves it. Get on it. So hopefully you found value in this course. Please like, share, get this out there to people. Share this masterclass with other people. I've got the playlist down in the description below. You can share the link to that playlist. That's probably the best way to do it. Rather than making this a big course that I'm making people jump through hoops with, or through to be able to get access to this thing, I just wanted to put it on YouTube, make it accessible so everybody could get here, everybody could have the free information, and that's it. Hopefully you found value in it. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.